Right, I wanted to do a video to explain the new approach I'm taking to my trading, because I've been working on trying to develop more of a mechanical way of getting into the market to take trades, because I've been finding, by the time I wait for price action to get into a trade, most of the run I'm getting is already gone. I'm usually getting about no more than 1.5 R on each trade, and now the method I'm using, I'm able to put in limit orders with a set, knowing where I'm putting my stop and my take profit before without even thinking about it. And what I'm doing, like on this example here, this is Friday, the 1 minute chart on spot gold, and we get price working down until it gets to this point where it turned around and went up and broke through structure, this structure point here, because it was this high that was responsible for creating this low. So there's a break of structure here and a change in order flow from short to long. So there's the low, there's the high, that's the low that was responsible for breaking this high. So I run a fib from the low to the high and mark off the 70%, 30% and the 50%, and then mark that zone on my chart, and then wait for price to come back in here to go to take a trade long. The target is the swing high, my stop is the other side of the swing low. Now this trade, I wasn't even awake at this time. But see, this would have been, because I like to use, I've been using this 70% zone. I know these are I put the fib in the wrong way around. So come back to 70% zone, get in there. 30 pips stop, get out at the high. So I'm getting out for about 60 pips if I'd got into the trade. So it's a 2-to-1 trade. So now we move on, and you can see this low caused price to break through this structure point and create a new higher high right there. Now you'd be expecting price to carry on, if it's going to go up, to go on and make a new high. Price failed to do that and broke through this structure point. So when price broke through this structure point, there was a shift in the order flow from long to short. So this was the high that was responsible for the break of structure. I mean, it's this one I like to use. You could use this one, but this was the higher high that was created, and this is the low that caused this higher high. So I run a fib from the low to the high marked as 70, 30 and 50 and wait for price to come back into this zone to take a trade. Now in this particular case, price never got back into here to go short. But what did happen was, you see, this was the move down. This was the when price started to move up. Price failed to continue up into this zone, came down and broke through this structure point. So I run a fib from this low to this high, mark off the 70, 30 and 50% zone, and then wait for price to come back up into here and take a trade from the 70% zone. So a 20 pips stop. Trade price back down to the swing point. That's a 4-to-1 risk to rewards. Oh. See, price reached that point there. So this is the low. This is as low as price got after the break of this point. This is the low that was created before price started to move up into this zone. We can see here we get a break of this low. So a break of structure. This was the high that caused the break of structure. Draw the fib from the low, this point, to the high, this point, marking the 70, 30 and 50% and wait for price to come back in to go short. Now this trade didn't reach the 70%, so I wouldn't have gone short off of this one. At this point we get price breaking through structure again, the low that was created after the break of this point before price started to pull back. So then this is the high that caused the break of the structure point. The fib goes from this point to the high with the 70, 30 and 50% marked off. Price came back to the 50% point and then went. And this trade I was in. So what did this make? So it was a 2.5 pip stop. Or a 25 pip stop with a 60 pip take profit. So, well, just over 2-to-1 risk to reward. And you know, this is all based on you know, the way I trade. You know, what I picked up from Chris Laurie from watching his videos. You know, when you see price break through a low, price will work its way back to mitigate the break of structure, and the faster price breaks that through a structure point, the better, because the more inefficiencies that will get left, and you'll get price work its way back in to test the point and fill the inefficiencies in. Because you can see here how fast price went, left inefficiencies here. We can see price came back to fill it in and went. And you see the point of it is, I know exactly where I'm looking for structure breaks and price to pull back to take trades. And if price goes through, like when I entered this trade, if price had broken through this structure point and started closing the other side of this structure point, there's a switch in the order flow from short to long. You see, as long as price keeps breaking through structure, creating new lows, and doesn't break through these structure points high, then I just carry on trading short. See, it's only when we get to a point where price breaks through structure, there's a shift in order flow, that you start looking to trade the other way. That's basically all there is to it. Because, like I said, it was Chris Laurie that pointed out, you know, when price breaks through these points, it'll try its best to come back in to fill these points in, the breakout area. You can see it doesn't happen all the time, because up here, price never got back to mitigate any of this. So this level is unmitigated. I mean, eventually price will get back up here and mitigate it. And it'll, you know, I only tend to use daily levels with it, you know, the structure points with it on a daily basis. I won't be dragging this through into next week and expecting price to come into here. But you know, this creates, for me, it just creates a far more mechanical approach to my trading, and I'm not getting caught on the wrong side of price. Because, you know, price started going up here, but it didn't break the structure point that created the low. That's the difference. In the past, I'd be seeing price not, you know, not making a new low after this point, and me thinking price is breaking higher, but it's not. It's just coming up to mitigate this point to continue going lower. But anyway, I just thought I'd just make a quick video, or a quickish video, to try and explain this approach to my trading now. Anyway, I'll leave it here. If anybody has any questions, just leave a question in the comments, and I'll get back to you. Okay, bye for now.